And I want to start with a kind of where we are in very basic terms, a kind of economics 101, if you like, and put the place of investment and finance in that economy. And here's the very familiar circular flow of the economy as it exists. Lots of people buying lots of stuff, us saving and investing, sometimes in the firms, but also in increasing productivity so that we can do more and more of it faster and faster, and allow ourselves to indulge in the novelty of having ever newer, greater consumer stuff to play with. And it's not, funnily enough, a very green economy at all. It's a rather dirty brown economy, and the financial sector plays heavily into that through financing not just the real investments, of course, but consumer credit that allows us to buy the things we don't need to impress the people we don't very much like, with money we don't have, and also a lot of speculation into the issue. So we have actually three big tranches of financing going on within this simple picture of the real economy. And just to give you a flavour of what that looks like in terms of scale, here's net lending by UK banks from the last 4 decades. And it is extraordinary, really, how much that's increased, but it's also extraordinary how the composition of that has changed, so that households is a very big swathe of that funding. A lot of it, of course, built around housing bubbles, some of it unsecured by any assets whatsoever. And the middle swathe, the financial corporations lending into bank lending to financial corporations, the speculative bit of the economy, not really contributing to even to GDP growth directly at all, but there as a kind of, if you like, lip service to the god of liquidity, to the idea that liquidity will deliver to us exactly the things that we want to make an economy work, which of course is incredibly heroic, worked up to a point, did deliver lots of commodities, lots of goods and services, expanded the financial service sector, allowed the UK to claim that it had growth for almost a decade, and then of course also led to the crisis. So these three bits of the finance sector are the foundation of what we might call the conventional economy. Even the real investment in that economy is short-termist, rent-seeking, degrading of environments, depleting of resources, often sucking value out of supply chains at the cost of ordinary people and the planet. So even within that spectrum of speculative consumer lending and real investment, the real investment bit is not being directed where it's needed for a really green economy. Fair enough. So what would a green economy do differently? Well, I'm not suggesting that it has a radically different model. Of course, people still engage in enterprise in order to deliver the services that we need in order to make our lives better, and they provide us with the incomes that we can spend on those services. That still exists. The green investment bit of that, however, has to be much, much more carefully targeted. It has to have a different portfolio of investment. It's likely that that speculative component disappears or becomes marginal. The productivity pursuits that we engage in are around resource productivity rather than the labor productivity that tends to chase people out of jobs and make us more and more reliant on growth in order to achieve full employment. And the investment that is required, the financing that is required, certainly has lost that speculative component, has a much smaller component in relation to lending to consumers to provide affordable housing, and has directed investment into the economy in ways that build a sustainable green economy that falls within carbon budgets, that doesn't deplete resources, that is socially just along its supply chains, and so on and so forth. Here is the position of green investment in a truly green economy. It defines, a green economy is defined, at least one way to define it is it has a concept of enterprise based on services. It is about employment, particularly in those service sector jobs, which are employment rich in their nature. It has an investment in which the targets are ecological and social, about the protection of the assets on which we depend for future prosperity, rather than simply the profligate speculation in terms of commodity bubbles and rent-seeking behaviors in degrading activities. They are the kinds of assets that give us genuine prosperity. And this target, this portfolio, demands a different ecology of investment. It isn't just about the portfolio being different, it's about the ecology being different. It has to be a sense of slow, patient capital with sensible, appropriate rates of return, with investors linked to savers, and the kind of mechanisms that many of the talks this morning have alluded to. And the money sector in that economy has to be about appropriate institutions. It has to have good sector balances, a subject I don't have time to talk about, but is actually rather important in designing a financial economy. And it has to have something akin to a green money supply. And as many people have already pointed out, that isn't necessarily a money supply 97% created by commercial banks at interest. We can come back and talk about that later. The portfolio of investment itself, it's often heard, you will often hear green investment as being roughly about green technology, as though we can fix the existing technology, the existing economy, if we had a cleverer set of technologies and we invested in them fast enough. In my view, that's a partial understanding of the investment needs of a green economy. It has also to be about infrastructure, about public infrastructure in particular, around building infrastructure, around community spaces. It has to be about the protection of ecological assets as well as financial and physical assets. And it has to deliver us the kind of enterprise that really makes sense, the bits of the economy where it makes sense to grow in services, in health, in education, in social care, in renovation and refurbishment, in an economy of care, of craft and culture, where people's time and skills matter in the economy in terms of delivering prosperity. This is where investment has to flow. To do that, here is the slide that I probably should have spent most time on, but I will show you really, if you like, a smorgasbord, a selection of ways of intervening in investment and in the financial markets, which are essential if we're to see this green economy grow to scale. And they range from the small scale, from things that are already being done, from peer-to-peer lending, community bonds, community banking, many of the things that we've talked about this morning. They will never flourish in an economy dominated by fast, ruthless capital. And so it's essential to make changes in the institutional sector of the market. And that can start, of course, with the simple interventions of just governance, of environmental and social governance in the management of funds. It can start with screening out the things that are really bad for people and for the environment. But it has to move beyond that. It has to create funds for good, funds for a green economy. It has to create impact investments. And again, none of that will really happen without intervention at macroeconomic scale. We have to call on government to intervene at macro scale in the financial regulation of markets, in the legitimacy of fiduciary duties of funds, fund holders, and share managers. For example, a hypothecated transaction tax, which would slow down the speculative trading, in which the returns from that tax could be used directly in the funding of green investment. And I was asked to talk, and I will mention briefly quantitative easing as a potential way in which green funding could come back into the economy. I am personally still waiting to see a fully fledged green quantitative easing program, but it does seem to me that it's set up, for example, by the shift that Bernanke and the Fed introduced between quantitative easing and credit easing, which is one step towards credit allocation in the market, and a nod towards the idea that green sovereign spending might actually be a part of what influences things in the market. So it goes beyond actually putting more money in the market, hoping the market will do it itself, and it starts to target those initiatives in ways that support the investments that are needed for the green transformation. Some of that relies, of course, on a different ideology about money itself. The commercial creation of the money is not going to deliver it, I would argue. We need to have a campaign, a set of ideas, a set of robust ideas that will lead to and reinvigorate the idea of sovereign spending in the economy, targeting investment where it's needed. It's the complete opposite of austerity policy, if you like. But it has, remarkably, a longer pedigree than just 5 or 10 years. It actually has an 80-year pedigree. It goes back, of course, to Fisher and the Chicago Plan, and it's fantastic to find, I am about to stop, that the lovely angels of the green economy, the International Monetary Fund, recently published a working paper on the Chicago Plan Revisited. The point I will end on is that these initiatives are already there, they're already in existence, they have long intellectual pedigree, and some people, bless their hearts, have been doing them for many years. Thank you very much.